Welcome to Bunnex Investment Group. In this video, we are going to break down a powerful trading checklist that any trader must apply. This checklist is universal and can be applied on indices, currencies or commodities, or even metals, any tradable asset. But before we go through, make sure you subscribe to this channel and check the notification bell icon if you haven't done so. So we are going to explain this in three parts. The first part being pattern definition, and I'll give you an example of how I do it. Then the second part is pip compression check and market volatility. You really need this to actually trade properly. Then the last but not least, there are entry triggers and account exposure management. You need to know how much you're exposing your account to the market. So the first topic is pattern definition. So a lot of traders succumb to the problem of going into the markets without any idea of what they are looking for. So I've seen several traders actually coming to me confused of how to trade or what to do whenever they open their charts. So the first question you should keep asking yourself is, what do I look for whenever I get in front of my charts? If you open euro against dollar, what do you look for? If you open any pair or any tradable asset, what do you look for? In this video, I'm going to review how I do this using one of my favorite patterns, which is the peak MOW. It's actually a reversal trade type. So next is how you should define your pattern. So the first thing that you need is to actually have a pattern name. Probably you have several of them. Like in my case, I have around 6 trade patterns that I look for on the charts. I have different accounts, and each account has certain patterns that it can only take. So in this case, my pattern name for this example is multi-session peak W or M. The time frame for that pattern is 1 hour time frame. And position of occurrence, meaning where does it occur on the market, within the market flow. It occurs at third level or after the cycle is completed, this H1 cycle. Then session of occurrence. It doesn't mean that it doesn't occur in Asia or London, but the only session that I need to look for this particular pattern is the US session. So this is what I call the pattern definition. You should actually define your pattern in this manner. Then the steps of taking that particular pattern is you need to first check the higher time frame bias, right? Have you done it? Yes, right? I've checked the higher time frame bias. I've seen that we are going up or we are going down. Count levels on the H1 time frame. Have you counted the levels on the H1 time frame? Yes. Are we now on the level 3 as we said? Yes or no? Respect the high of day 3, meaning that after having this, we need to actually locate the high of day 3. Then the second leg must occur in the US session. So the first leg, the second leg must occur in the US session. Compare with flashcards if not sure of the setup, like in the next slide. So flashcards are there to actually help you compare the patterns that you see on the charts with what you are actually looking for. In this case, this is a snippet from USD against CHF. We had a completed cycle here. It's unfortunate level 1 was actually cut from this point. We had 1, 2, and 3, right? On the third day, we actually had the high of day, which was set here. Then on the following day, we actually were looking for the second leg in the US session, right, which was actually given. So after confirmation, we actually took the trade, right? It now depends on your trading plan. How much do you take whenever you enter such a reversal trade pattern, right? From that, we had 1, 2, and 3. And at level 3, actually at the end of level 3. That is where we actually anticipate to see this pattern, right? So this day, on this particular day, we were actually now waiting to see another leg coming in the level of the first leg and occurring in the US session, right? And this leg was issued and the market played out, right? So it's not about winning each and every trade, but for this point, we are trying to emphasize that you need to have a trade pattern definition. What are you looking for? So why you should have a proper pattern definition? You should have a proper pattern definition so that you won't get lost or experience what we call analysis paralysis, right? Analysis paralysis is a point or process whereby you won't be able to actually or not know what the market is going to move or to do. You analyze this way, you see that the market may go up, and you analyze another way, you see that the market is going down, and another way you see that the market is ranging. So if you have a proper pattern definition, you only need to look for your pattern and trade without fear. So let's go over the next trade checklist, which is pip compression check, which is also important before you take any trade. But before we do so, I have an announcement to make. We are going to hold a 3-day professional trading training from the 28th to the 30th of June 2022. The time will be 15:30 GMT, and all lectures will be actually recorded and provided to students. So the fee for that is going to be $200, and if you once purchased anything from us, it's going to be $110. So this is all going to be done on Zoom, and these are the topics that we are going to cover. Day 1, which is charts nomenclature, it's going to cover to be done in 90 minutes, and these are the topics. Day 2, market maker tactics. We are now in the trading operations, right? It's going to also be done in 90 minutes. Then the last day, which is trading operations, it's going to be 90 to 120 minutes, and we are going to cover all these topics. So if you really want to step up your game, you need to actually enroll for this class and see your trading changing. So the next topic is pip compression check and market volatility, right? So pip compression is the magnitude of pips covered per day, and we can call this the average daily range, or ADR in short. So we should always know that a trading year is divided in quarters. Some quarters perform better than others because market makers manipulate a lot, and they'll need to accumulate for the following quarter. So by quarters, we are saying January, February, March is actually the first quarter of the year. It's used for accumulation, right? Usually the ADR of most pairs within the first quarter is actually compressed. By compressed, you'd see that probably CAD against CHF will be moving 25 pips at most or 30 pips at most per day, right? Whereas if we go into the second quarter of the year, we are now seeing the market makers making long sustained run after the accumulation of the first quarter. So in the second quarter, which will be expanded, you'd see that the same pair that was moving 20 to 30 pips per day is now moving 60, probably 80, sometimes even 150 pips in one day. Then the third quarter, which is now mid-year, right? So the third quarter will now have July and down to September. Then it's also an accumulation phase. So within these accumulation, you'd find out that the market will be it will be very difficult to predict how it moves. There will be a lot of consolidations, big swings to the high and low, and so forth. Then the last quarter, which will end in December, it will actually be an expanded quarter where you see the market making long runs of flows. So before you place a trade, you must be aware which quarter are you, to understand or anticipate how many pips to be placed on the stop loss side as well as target. I've seen several traders actually sticking to a fixed stop loss magnitude, whereby they would say, I only place my stop loss at 20 pips. In some instances, you'd see it working, and in some instances, you'd find out that you'll be taken out very easily. So you need to know which quarter you are and how much pips are compressed within a day. So that is what we mean by pip compression. You need to always check how much compression is within the markets. Then the last topic, but not least, is entry triggers and account exposure management. So these are the three things that you need to do before you place a trade, right? We've talked about the pattern definition, pip compression, and now the entry triggers and account exposure management. Yes, you have defined a pattern, but the most important thing is when you actually press the buy or sell option. So with this, it is important to know your entry triggers before the actual trading is done. By that we mean you've seen, of course, the first leg and the second leg, but when do you actually place a buy? So in my example, or for my particular trade pattern that I've defined earlier, I'll be actually looking for high-low candles, closure below base, railroad track on the second leg for me to enter. So if I see any one of these, I'll actually press my buy or sell depending on the market context. So that is basically an entry trigger that you need as well to be defined. Then the other thing is now the account exposure management. So with that, we say trading is not gambling. You should not feel lucky in any trading day that you feel like risking it all. I've seen several traders actually placing thousands of trade on a very small account. Sometimes it will work, but that will be running on luck, and luck will always run out. So always remember that each and every trade has a 50-50% chance of losing. No matter how much analysis you put in, no matter how much you dissect the charts, it always has a 50-50% chance of losing. And a losing streak is also very, very much possible to have 3-4 trades in a row losing. And it doesn't mean that you are not a good trader. It all runs down to how much you're exposing your account on each and every particular trading. So I challenge you to try this 3-step process on any pattern of your choice and see if you won't see changes in your trading. Do it from today, check your results in the next 4 weeks, and actually come back to comment on this video. On that note, we come to the end of this video. Thank you for watching. Like and subscribe, and check out our free Telegram channel. The link is right in the description box below.